Hi guys, welcome to my channel. Okay, so please don't forget to subscribe. So today I'm doing income taxes IAS 12, and what I want to do, I want to be as brief as possible because I don't want to go into detail of IAS 12. So I will only do the things that I think are important and necessary to know for the exams. Okay, so let's go. This is my table of content. Okay, and obviously I start with the objective and everything else. So I won't go through the table of content, but rather let's just get to it, and then yeah, we'll see what happens next. So let's go. Obviously, the objective of IAS 12 is to prescribe the accounting treatment for income taxes. Okay, so that we all know. And what I wanted us to start with is the definitions. Okay, and with the definitions, because I know you guys know the definitions, I'll just be quick and summarize the definitions. So one thing I want us to know is that we have an accounting taxable profit and the taxable income, okay, as per the SARS. So the accounting taxable profit is calculated as per the accounting standards that we all know. Okay, and then we have the taxable income, which is calculated as per the tax legislation. Okay, so that we all know. So if accountants they calculate their taxable accounting profit using the accounting standards, and taxman uses the tax legislation, it means between those two taxable profits there will be a difference, and that difference is what is called the temporal differences, which give rise to the deferred taxes. Okay, so with that, you know that the difference between taxable income and taxable accounting profit, it gives you a deferred tax, which is a reconciling tax between the tax as per accounting profit and the tax as per the taxable income. Okay, so going to the tax base versus the carrying amount. Obviously, the definition of the tax base is very long in the standard, and I won't go through it. But what I can tell you is, when I explain this thing to myself, okay, I know the carrying amount is per accounting, that it's cost minus accumulated depreciation, and then you get the carrying amount. So the tax base for the property, plant, and equipment, just listen to me carefully, for the property, plant, and equipment, it's obviously going to be the cost less the wear and tear, and then you get to a tax base. So it's actually the same thing, okay, but the difference is that the wear and tear allowance is not always the same as the depreciation, which gives rise to now the temporal differences. Okay, wonderful. So we know I've talked about the temporal differences, and we've also got the permanent differences, and we all know that temporal differences are the ones that results to a deferred tax, a deferred tax, a deferred tax asset liability or whatever. Okay, that's fine. And then we've got these permanent differences. These are the amounts that will never be taxable or will never be deductible to get to a taxable income. Okay, so SARS and accountants, they treat these ones the same. Hence, getting to accounting profit, you take into account your permanent differences, and then you get to your accounting profit. Okay, so quickly, just so you know, your accounting profit, it's the tax that the accountant, okay, no, let's leave that one. I think we're gonna talk about it later, because I have this note, and I think it's gonna explain that thing very easy. Okay, so let's just make sure that you're gonna do it right at the end. Okay, and okay, let's carry on. The permanent differences are the ones that results to deferred tax, and the permanent differences are the ones that are the same between those two things. Okay, like for example, let's say if we have a building, it's non-deductible. Okay, it's non-deductible. and yet we depreciate that building. Okay, so that difference between us depreciating the building and SARS saying it doesn't have wear and tear allowance, that difference will always be there. It will never reverse in any day. Hence, that non-deductible, that depreciation that we've put through in our income statement has to form part of the permanent differences. Thank you. Then let's move to what is very important, the recognition of deferred tax liability, right? So what is happening here is we know we have a deferred tax liability and we have a deferred tax asset. So I wanted to deal with the deferred tax liability first, and then I deal with the deferred tax asset separately because it's more interesting. Okay, so what the standard says is a deferred tax liability shall be recognized for all taxable temporal differences. Let's just stop here. It means wherever you have a taxable temporal difference, you need to recognize a deferred tax liability. That's what it says. Wherever you have a taxable temporal difference, you need to always recognize a deferred tax liability, unless, and these are the conditions. So if that taxable temporal difference is as a result of goodwill, then it's exempt. Why? Because you will carry goodwill at the carrying amount as per accounting standards in your financial statements. Okay. But SARS will say, no, we don't recognize goodwill. Our tax base for goodwill is nil. Okay, because goodwill is exempt even when you impair goodwill. The impairment of goodwill is also non-deductible. So SARS will say, you know what? We have a nil tax base. Okay, so if that's the case, a temporal taxable temporal difference equal to the carrying amount of goodwill will arise. And if it arises, it means you need to recognize deferred tax liability. But now it says if it is a result of goodwill, we don't do that. Okay. And number two, initial recognition of an asset or liability in a transaction which is not a business combination. Okay. So what this means is if we buy an asset, let's say you buy a building, okay, this building is depreciable, wonderful, okay, but now what SARS says is this building is non-deductible as per income tax. So if that's the case, again, your tax base is going to be nil. And when you compare it to the carrying amount, obviously you're going to have a taxable temporal difference which need to give rise to a deferred tax liability. But because this arose from an initial recognition of an asset and we are not in a business combination, okay, and it doesn't affect the accounting profit nor does it affect the taxable profit, then we don't recognize that deferred tax liability, we exempt it. Okay, wonderful. Let's quickly move to the recognition of deferred tax assets. This one is very interesting. Okay, so again, a deferred tax asset shall be recognized for all deductible temporal differences. Okay, again, it means wherever you have a deductible temporal difference, you need to recognize a deferred tax asset to the extent, listen to this carefully now, to the extent that it is probable that the taxable profit will be available against which deductible temporal differences can be utilized. Yeah? So we all know, that's the first condition, we all know that to recognize an asset, we need to know that it is probable that there will be future benefits from this asset. So again, for a deferred tax asset, it follows that rule. Okay, we recognize to the extent that we expect to receive the profits in the future against which to realize the deferred tax asset. Okay, then while we are still there, this thing is very important, especially when you are dealing with assessed losses. Okay, if you deal with assessed losses, you know assessed losses, they give rise to a deferred tax asset. Wonderful. And then you are making losses already, so you need now to be comfortable and know that, okay, for me to recognize this deferred tax asset that arises from the assessed losses, will I be able to make profits in the future? If your answer is no, it means no profits in the future. Then you don't recognize the deferred tax asset unless you know, or unless it is probable that there will be future in the profit against which to realize that deferred tax asset. So if it's not probable that there are gonna be profits in the future, don't recognize the deferred tax asset. Okay, and this unless going down here, it's exactly the same as what I explained in the deferred tax liability. Okay, so when it comes to this deferred tax asset, I will explain it very well with the assessed losses, and I think later in this class there is an example to deal with assessed losses. Okay, so just quickly, what is important in here? Where a company, let's look here, where a company has both taxable and deductible temporal differences, the deductible temporal differences will normally be provided to the extent of taxable. So it's just explaining this. Okay, so it means if you want to, if you have a deferred tax asset and a deferred tax liability, your deferred tax asset should be provided, or your deferred tax asset should never exceed your deferred tax liability if that deferred tax asset arises from the assessed losses. Okay, just process that. Wonderful. Okay, now let's quickly move to the income tax rate change. Okay, so quickly, we know, if you, I stand to be corrected in this, I think the rate this year it's 28%. Okay, now let's take for example our year ends in 31st December 2020. Okay, and we apply the rate of 28%. What happens now when we get to next year and our rate now changes to 30%? So this part deals with that. You need to know that in our financial statements we've got two balances. It's either we have the current tax liability or current tax asset, or we have the deferred tax asset or deferred tax liability, and of which these two things are measured differently. Okay, so now we need to know the measurement of current tax and the measurement of deferred tax, because it has an effect on how to apply the income tax rate change. Okay, let's talk about the current tax liabilities. Okay, what this says is that the current tax liabilities or assets for the current or prior years shall be measured at the amount expected to be paid to or from the taxation authorities. What this means is that if by the end of this year, which is 31st December 2020, we owe SARS 50,000 rand, okay, which has been calculated at 28%. It doesn't, and if we get to next year and the rate changes to from 28 to 30%, it means that we still owe SARS 50,000 rand, even though the rate has changed. But what we owed SARS on 31st December 2020, it's what we owe SARS in the next financial year. It doesn't change because the rate changed. The change in the rate will only apply it to that next year's income tax expense for the year. So the rate change does not apply to the balance of the current tax. But now see, with the deferred tax asset and liabilities, how it is measured. Okay, so how this is measured is deferred tax assets and liabilities shall be measured at the tax rate that are expected to apply to the period when the asset is realized or the liability is settled. So the idea behind the deferred tax is that if it's a deferred tax asset, it's going to be realized in the future, not now. And if the deferred tax liability, it's going to be settled in the future, not now. So now it says you need to use the rate that you expect. You need to use the rate that you know or that you expect will be applicable when you settle the liability or when you realize the asset. So if now 2020 December the rate is 28% and then next year the rate is 30%, that deferred tax asset is clearly not realized in 2020 but will be realized in 2021, which means you need to use the rate of 2021. Therefore, if you get to 2021, it means you need to remeasure your deferred tax asset or your deferred tax liability to the new rate. And obviously, the difference, which is going to be between 28% and 30%, will be recognized in your P&L as either a deferred tax income or a deferred tax expense. Okay. And lastly, for part 1, because I'm gonna divide this video into part 1 and part 2. Lastly, for part 1, let's do the tax rate. Clearly we have 28% and 22.4%. 22.4% obviously is as a result of the capital gains tax. Okay? So what determines which rate to use, whether 22.4 or 28%, is determined by the expectation that the accountants make about the asset. Okay, so if you expect to use the asset throughout up until the end of it, it means you expect to recover the carrying amount through use, then it is, and then you need to use 28% for your deferred tax. But if you expect not to use the asset throughout, but you expect to sell it at some point in time, you need to use 22.5%, because if you expect to sell it, it means now the capital gains tax rules, they come into play. Okay, and just to expect this, just to make sure that this is clear, let's look at this example. You have a machine which is revalued to 1,000, which means the carrying amount is 1,000, but the original cost was 800, and the tax base is 400. Okay, so you know difference between tax base. Okay, now you have 1,000, which is the revalued amount, against 400, which is the tax base, and then you get a temporal difference of 600 rand, which will give you a 168 deferred tax liability at 28%. Wonderful. If now it says that if the entity intended to sell the plant at its current value on the first day of the next financial year, then it means only the 400, which is the cost and the tax value, will be recoupable, and then that will apply to an 8% rate. But the amount that is above 800, which is 200, because now the asset has been revalued to more than 800, it gives an indication that you expect to sell the asset at 1,000. Okay, and then applying capital gains tax rules, which the cost is 800, it means the 200, it's the capital gain, and the deferred tax from that 200 should be at CGT rate. Okay, but any temporal difference that is below 800, it means you need to apply 28%. Then you add the two, they give you a deferred tax for that period. Okay, so this is where my part 1 ends. Please stay tuned for part 2, where we're gonna continue with our class, and we'll be looking at items in OCI and P&L, income versus balance sheet method, and we look at the assessed losses in detail and the income tax note. Okay, take a break and bye.